Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat and corn. I'll start with Chicago wheat. There continues to be a lot of complexity here in recent days, and by recent days I mean both this past week since my last commentary and since the peak in November. If we just take a look at the actions each day since Thursday last week, we have had, in this order, a combined key reversal down and bearish engulfing pattern, a combined immediate countering key reversal up and bullish engulfing pattern, an indecisive spinning top, a bearish opening black Mariposa, and then yesterday, a bullish closing long white Mariposa. Taking a step back for the moment, the most obvious recent pattern was the monthly key reversal down made in January. This was completed with a big combined daily key reversal down and bearish engulfing pattern on the last day of the month. So some pretty heavy duty incentive there, or so it seemed. Okay, so this next piece is a complex piece of technical analysis patterns recognition. So we currently have possibly 3, maybe 4 patterns in operation all at the same time. The first one is a complicated head and shoulders pattern from the beginning of November last year until early January this year. It looks a little lopsided and the neckline was breached, currently at 725. However, there was no follow through lower from this breach and the market has since turned back up again. Yet here again, this has not as yet turned out to be a head and shoulders continuation pattern, as the market barely made it up over the top of the right shoulder in late December 2021 at 827. And it did not approach the top of the head in November 875. This is a conundrum and one that is still not sorted out, as we shall shortly see. The one pattern that was completed and reached target was a small early to mid-January double bottom, which led into the attempt just over the right shoulder. The second pattern is one in the making. It is to look at the action from late November last year to date as a possible reverse head and shoulders pattern, still in construction. So far we have formed the left shoulder in December and the head, which is the split head in January, created by the previously mentioned double bottom, and we may right now be forming the second shoulder. It all depends if prices turn back up to the neckline, currently at 840. This is not by any means a perfect pattern, as it intuitively seems to be too high up in price, but the potential action since November 2021 does look appealing. The third possible pattern is created from using a combination of 2 necklines from the previous head and shoulders patterns to form a possible expanded wedge pattern. Thus we have an upper wedge trend line currently at 840 from the November last year to date potential reverse head and shoulders pattern, and the lower wedge trend line currently 725 from the earlier beginning of November last year until early January this year head and shoulders pattern. There is a certain elegance to the pattern, though once again it seems to be slightly in the wrong place. Finally, there is a possible bear channel formed from the neckline currently at 729 of the earlier beginning of November last year until early January this year head and shoulders pattern, making the lower bear channel line, and the mid-November 2021 to date downtrend currently at 816. That's making up the upper bear channel line. This one is also interesting and has merit. Now I know this has been a lot to process that I've thrown at you in a short amount of time, so please feel free to replay this part of the video to see what I mean. I just hope that I've managed to get my somewhat complex points across. I've earlier tried to show in detail what has happened since last week's commentary. The overall outcome is that the market is now approaching the upper bear channel line, currently at 816. This does not bring us much closer to finding out which of the previously described pattern scenarios is more likely to be true. We'll still have to just see how and if these patterns play out. Chicago corn. The move up from the original July to October 2021 descending wedge pattern sort of continues further up this past week, but it is not the most inspiring piece of action. The original way up was started by the support offered back in November of last year by the long moving average currently at 576. This led to last November establishing a small, very shallowly bullish bull channel, currently 582 to 602, with the long moving average acting as the core support. By mid-December, the market attempted a break higher. However, this attempt higher was swiftly batted down, but not enough to extinguish what has turned out to be a fresh, slightly stronger, bullish incentive as prices created a new, more acute bull channel, currently 606 to 657. This time the driving force higher seems to have been, and still is, the more acutely rising short-medium moving average, currently 611. Now, this had become intertwined with the lower bull channel line since early January, but is moving up at a slightly higher rate now than the newer lower bull channel line. Recently, we saw a significant move up and stabilization over the 50% Fibonacci line of the May to September 2021 move at 616. This happened 3 weeks ago, and since then prices have moved up to the upper bull channel line, currently at 657, piercing it last week, and this as well, but not breaking it. However, this possible spike higher opens the way for yet another pattern. It is look at the late December last year to date action, including a possible spike higher as a possible ascending wedge pattern. Now this one is very early on, but it utilizes the early January to date uptrend, currently at 630, along with the connected highs from late December, currently at 669, as the outline of the pattern. Whilst the market is now out of the original bull channel formed last year, it is still within the more acute bull channel and the new ascending wedge pattern. Thus, it is important to note that after the June 2021 high resistance at 649, which so far, despite earlier thoughts, has not looked that capable of holding prices down, we have seemingly little of note until the March 2013 high at 719. I'll let that sink in for a bit. For your information, both the upper bull channel line and the upper wedge line are both higher than the 649 level. The only thing is that the market is taking its own sweet time about trying higher, which is to say the least disconcerting. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.